Kitco News special coverage of the Rule Symposium, Natural Resource Investing, is brought to you by G Mining Ventures.
Hey everyone, I'm Jeremy Szafron. You're watching Kitco News, coming at you from the Rick Rule Symposium in beautiful Boca Raton, Florida. Now, investors are feeling the heat on the ground, but also the momentum here, looking for ROI and opportunities in the precious metals space. And our next guest advises individual shareholders in equities and stocks. He specializes in corporate credit and in debt. He's also a macroeconomic strategist with a bit of a different take.
Yes, sir. Equities and credit, global.
And credit, okay.
Yes, sir.
Global macro.
Yes.
Let's talk about it, because you and I just started talking a little bit before we pressed record. And we were talking about the S&P and how they're reaching all-time highs, whether or not there will be a correction. You're of the belief we got a long way to go. We got a big run happening here, potential growth.
Yes.
It's going to overperform.
Yes, we cover 32,000 companies globally. All right, our coverage blows away all. I'm seen as anti-Wall Street because we have clean data, we have uniform data, it's unbiased, we don't do any banking business for it. We're just an investment research shop. And when you add up the corporate earnings, the economic profit, the true economic profit of US companies, the earnings are 3 times the rest of the world's companies combined, right? And at new highs. So when you say, well, the stock market's at a new high, well, yeah, because corporate earnings are at a new high. And I'm not just talking about GAAP accounting corporate earnings. I'm talking about uniform, properly calculated, the way Buffett and Charlie Munger and Seth Klarman and Ben Graham has taught people, right, since he was writing books 70 years ago, right, that what we should be doing is some uniform accounting number to understand earnings. Well, when you look at that, that's at record highs. So the two are going together. So the idea that it's overvalued is like, well, as long as the earning power is there and US corporates are generating that earning power, we had a little bit of, I call, an earnings recession last year, but not now. And so new market highs follow with new earning power highs. And so if you're going to say, yes, but what if earnings collapse? I'm like, okay, if earnings collapse, then yes, the market will collapse also. But we don't see that happening. If anything, everything is firing off on the S&P 1500, S&P 500 earnings continue to grow. Now, could there be a correction? Of course there could be, right? Could there be headline risk because the market's trading at 20 plus times earnings? Yes, there could be some headline risk. But that could easily go to 28 times earnings or 30 times earnings before it falls.
Yeah. There's some interesting analysts out there that kind of argue the point and say, okay, we've had this AI boom. We've had a little bit of go into the tech sector. We had a lot of money come from the government into the pockets of Americans, and a lot of places where there was money going from the government in terms of, I'm curious, you know, when you look at it from that perspective,
yes.
Macroeconomics here, a lot of analysts say that those are not going to continue, but the reason they're not going to continue is because they were overvalued in the first place. What's the argument?
The issue is, so this analogy is really, it's like 97, 98, right? Where things looked expensive, and then because of the dot-com, because of the internet, because of PC productivity, they said, oh, it looks expensive. And if you remember back then, we had an internet industry, and people talked about internet companies, right? Well, what happened 5-10 years later? Well, 5-10 years later, right, you had all companies were dot-coms. Is there an internet industry today? Of course not, because every company is an internet company now. Every company has a dot-com. Every company is benefiting from the PC revolution. That's what was happening with AI. So right now, people are tying AI to a handful of companies and saying, oh, those are the AI companies. There should be an AI sector. When in reality, the entire S&P 500 is going to benefit from AI. All companies are going to have higher productivity, much like the PC boom, much like the PC productivity boom in the 90s. And what we're looking at right now is more like a 96, 97, 98 with another couple of years or more to go, as opposed to saying, oh no, it's already 2000 and the bottom's gonna fall out. What is making you say it's gonna fall out, right? Well, in 2000, we had a credit crisis, right, of epic proportions. That is not what we're looking at right now. So
even the argument that, we have, trillions in debt, and the servicing that debt with the US government is so high. I know that, the revenue can kind of cover that, but where is it sustainable?
Well, we're not buying the U.S. government, are we? We're buying U.S. companies. And U.S. companies are generating money in ways that are separate from the U.S. government. And the CFOs of U.S. companies, by the way, the S&P 1500, should get an applause for how they've managed their balance sheet. So while the interest rates are now a lot higher, corporate debt service this year is lower. You're saying, so what do you mean? The CFOs expected that interest expense is going to go up, so they purposely refied their debt to spread it over a longer period of time for debt payment. And so when you think about total debt service or cash flow needed for debt service, the interest is higher, but the debt actual pay downs are lower because they've spread it over a long period of time. So when you look at U.S. companies, you're looking at a totally different situation of how they manage their balance sheet than thinking about something like the U.S. government, which you'd argue has a lot of room to improve, to say the least. Although at the same time, I don't think the U.S. U.S. government's in any. Right now, U.S. debt is not at a problematic level. It isn't.
That's
even
so
at current interest
fascinating.
rates.
I mean, our audience is going to go, what are you talking about?
Yeah, I get trolled on this all day long, but
Explain
the data is
this.
there.
Okay.
All right, so when you're looking at debt levels, you have to think of it like an actual credit analyst. So think if you're a banker and you're loaning money to the U.S. government. The first thing you say is, well, how much money you're making? Well, this year the U.S. is going to make $4.8 trillion in tax revenue. $4.8 trillion. What's the debt service level? $860 billion at current rates. Yeah. At current rates. So 4.8 trillion times 860 billion. Will 860 be the first thing they pay down? Of course it will. They're going to spend money somewhere else before they pay down that 860 because they know if they don't pay that 860 and they actually default, well, then it's going to become 2 trillion, right? Because they'll default. But as long as they don't default, that 860 stays there. And they say, well, yeah, but that's going to rise to $1 trillion in debt service in the next couple of years. I'm like, yes. And because corporate earnings at all-time highs, and because American personal income is at all-time highs and rising, the U.S. government will also collect on a lower tax rate than China or Russia or lots of Europe or Canada, right? On a lower tax rate, the U.S. government will be collecting, $5.2, $5.3 trillion, which means the income of the U.S. is going up fast enough to keep up with the increase in the debt service level. So no, right now it's not a problem. Now people say, but what if the U.S. Congress, and believe me, I don't think U.S. Congress should hear what I'm saying right now. I really wish they wouldn't, right? They should be hearing you're overspending and you're, like drunken sailors or whatever else, because you would argue that they are. The thing is the U.S. economy is bailing out Congress's irresponsibly every year with so much increased income, which on a lower tax rate leads to more tax revenue to the government, which is what you pay down debts with. Yeah. By the way, the other thing is, if you're doing your true credit analysis, the second thing you'll say is, okay, but what if you have some problem in your income? What do you have for collateral? Well, the U.S. is still the biggest landowner. The U.S. government is still the biggest landowner of the United States. It still has assets that they've never even considered privatizing. Privatize Amtrak, privatize the post office, privatize U.S. highways, right? Privatize some of the Grand Canyon and a bunch of things and actually put some nice hotels in there. I'm just saying, privatize these things.
So they could make more revenue.
It's easily $50 trillion plus the U.S. is sitting on for collateralized assets against the debt service of $860 billion a year rising to $1 trillion. Yeah, right now, it's not a problem.
We're seeing some cracks in the economy. We see the latest numbers. I think Claudia Stamm, she's an economist. We had her on fairly recently. The Stamm rule, there's a recession indicator. We're there. So I guess my point is, where are we? If it's a cyclical approach in this economy, and maybe we're not as bad as most people think, where are we? Where are we with it?
All right, so the question is there a recession? My answer is, and why do you care? I mean, I'm not saying that it's not important, but I'm saying the S&P 1500 and the S&P 500 are not representative of the U.S. economy, right? The U.S. economy, U.S. debt, and frankly, things like the Stamm rule and whether or not we're really in a recession. I think we definitely are in a recession in real estate. Heck, real estate, commercial real estate's a Great Depression, right? And will continue for another 5 years at least. Autos are definitely in a recession. I mean, you could go to large parts of the economy and say, there's some issues. But if we're talking about should you buy the U.S. stock market, there is a decoupling. When the U.S. stock market has a balance sheet collectively that's much, much better than a lot of consumer households and a lot of whatever else, when the U.S. stock market is able to generate record high earnings and consistently do so, and I'm talking about real cash flow earnings, not some silly Wall Street number stuff, right? Well, then buying the U.S. stock market during a recession might still be the right thing to do. What I'm getting at is, yes, I'm agreeing there could be a recession coming, but what does that mean? That means you better tighten your belts as a consumer. That means you better watch out if you have a small business. All right, there's a lot of things you do, but if you're saying, should I continue buying the S&P 500 and honestly, dollar cost average over 18 months so that if there's a correction, you could actually buy in heavy, right? Spread it over 18 months. I think that's the right place for your money to be if it's 5, 10-year, 15-year money that you're going to need down the road.
And I guess that's the key, right? If you're looking for a quick trade, maybe not the best idea, but if you are looking at ROI over a long runway, a long period of time, there's still room to grow.
Yeah, the S&P 500 is the best companies that have ever been made, the biggest cash generators ever, and they continue to be. If you just have to place your money for 10 years, it's going to do very well. It's going to outperform gold. It's going to outperform metals. It's going to outperform, most commodities, right? Like it has for the last 200 years.
Right. Okay, well, let's switch over there. What's your forecast on the precious metal space? I mean, first start with gold. We'll get into silver in a sec.
Look, I mean, I think given what's going with the world's currencies, right, the renminbi is going to get destroyed. I mean, the government's doing everything they possibly can to try to keep the renminbi from falling. Russia's doing everything they can to try to keep the the Russian ruble from falling. You have Turkey and other G20 countries that have crazy inflation. In any period of time where you have crazy inflation like we have, of course, precious metals are going to do well. My answer is that, so if we're talking gold versus a currency, of course gold is going to do well versus any currency. But is gold going to do better than US equities over a long period of time? The greatest 500 companies that have ever been made in terms of cash generation and the way they're continuing to generate, right? I would say, no, I'd be allocating towards US equities versus I would gold. I'm not saying gold might not be a great trade if we have Russia roll into Poland or something like that, or Estonia or something. And gold will be a great trade if suddenly China does invade Taiwan, but I think China knows not to. It'd be worse for China than for the rest of the world if China invades Taiwan.
And you don't think that that's coming anytime soon? I mean, we are under what? We got not very many months left until there's a possible new president in this country.
Well, the two most important elections for the United States economy already happened. And it's Xi Jinping being president for life and Putin being president for life. And as soon as everyone saw that, they said, okay, those are not future democracies. These are not reforming, right, pseudo-capitalist states. These are absolute tyrannical monarchies. They are, and they will continue to be. And because of it, almost every company has said, I want out. Now that's created an inflationary environment. It's not all monetary policy, right? So when suddenly you have China's super cheap production, not a benefit because they're going to steal your IP and maybe steal your factories, and Russia outright stealing planes and factories and everything else, right, since this war started, you're saying, all right, I'm going to relocate my assets and I'm not going to go back in those places or become dependent on Russia or China or friends of Russia and China for another 10, 20 years before you'll see that happen.
So has this opened up an opportunity for America then, in terms of future potential?
Yes, this is not they say it's the end of globalization sometimes, right? That's what they're saying, or a de-dollarization. No, if anything, you can see the whole world is saying, no, we want America's rule of law. We want U.S. shipping. We want the U.S.'s rule, as messy it is over the dollar, because at least the Fed has to say whether or not they're cutting rates or what they're doing. It's all televised, it's all recorded. That's not what happens in China and Russia, where they make little overnight discussions of, okay, let's start just buying our currency or selling our currency or whatever else on a certain day, right? I think the world is re-globalizing around the US as the center of it. The entire developed world is the center of it. And you've got these, call it breakaway states like China and Russia that at one point thought they rule the world, but they really don't.
So you think that the momentum, I mean, we have BRICS nations, BRICS Plus now, as it's called, just to kind of, say how large that is for a path forward with some of these emerging markets to kind of go into their own lane. That's not at risk here? That's not something that the U.S. is actively looking at or concerned about?
Well, so very specifically, if I use MSCI, it's not even emerging markets, frontier markets, right, and not one developed market. So the entire developed world is still dollar denominated. The entire developed world is still saying, meaning the bulk, and when I say the bulk, I'm saying 90% of the world's real money, right? And so you've got China, right, that is running out of money, Russia that's running out of money rapidly, North Korea, Venezuela, Cuba, right? There is no way India is going to give up their control over monetary policy to a combination of them, Russia, and China. There's no way China's going to do it either. Frankly, there's no way Russia's going to do it either, right? They all need control of their monetary policy to do what they're doing, Russia and China, from a totalitarian, authoritarian, monarchistic standpoint, right? Whereas India, I think, is going to say, and has been saying, I'm warming up to the United States. So these other countries, the Saudis are saying whatever. South Africa, they say, is part of the BRICS. Yeah. Have you seen South Africa's economy? They can't keep electricity on anywhere other than Cape Town. Even Cape Town's got rolling issues. So to say that these are powerful countries getting together? So no, not at all.
What is Putin's bet here, right? I mean, I saw this morning on Twitter that Modi was there. They're hugging. There was a big debate about whether or not they were going to hug.
Doing that.
Where are we at?
Yeah, but again, it's nice that they're doing that.
No one's doing it with Biden.
Right. Because he wouldn't know who he was hugging, at the time. No, I think India wants to maintain relations. And they want to balance that. But everybody wants, what Turkey has. I'm part of NATO, but I'm allowing Russia to sell through my country whatever they want at the same time. I'm supporting Ukraine in these different ways, but because I'm selling drones to the Ukraine, right? And at the same time, I'm getting money from Russia as being their only outlet, right, from the Black Sea. And so doesn't everybody want to do that, right? In these emerging markets, to say, I want to cozy up to both, right, the West and the Axis at the same time. Yeah. But that's very different from saying, I'm going to turn over all of my future to China and Russia's, right, combined BRICS regime and stay away from the U.S. and the rest of the developed world. right? Look at a map of the developed world. What part of it, right, is in BRICS? Zero.
So talk to me a little bit about the U.S. policy in terms of this, right? We can look towards this. I mean, you have a research house, you're looking at macroeconomic policy. What are the top three things you're looking at going into next year?
Going into 24, 25. One, like I said, we like the S&P 500. Two, we really love how much the Russell 2000 has underperformed. Not love it, but looking at that space for opportunities, because Russell 2000 now is incredibly inexpensive, and there's some gem companies there that are generating a lot of cash. And so I really like a lot of names in this microcap, small cap space that have not participated with the rest of the market, and yet the cash flows are there, so they should. And so it's only time for those to suddenly pop, and we'll see around there. And so while I like the S&P 500, individual stock picking, I'm really favoring microcap, small cap. All U.S., by the way, all U.S. There's no other part of the world that we'd feel comfortable putting our clients' investments in. We're a research shop. We're not actively managing money, but we know our clients pay attention. And so when we tell them, stay out of China 5 years ago, 3 years ago, 2 years ago, right now, we're saying China is totally uninvestable. And it is, right? It is.
So is future policy then going to, with whoever comes into the White House in October, nothing's really going to change? You're saying it's a bigger plan here?
I think there's some social issues that'll change. I think we're going to see either of them is going to put controls over the border, right, in a big way. But when you look at Trump's economic policies, Biden has doubled down on all of them. Trump was putting in tariffs to China. Biden has doubled down on those. Trump was cutting taxes. Biden talked about raising taxes, but he never really did, right? Not really. When you talk about Biden's focus on, the EPA and whatever else, he's allowed more building permits for oil and gas and construction, right, and infrastructure than Trump even did, right? And so when you look at economic policies purely, Biden has been more Trump than even Trump on that standpoint. So if you have a difference over social policies, yes, I think you might see some differences. But economically, it doesn't matter if it's Trump or if it's Biden, honestly, Biden with whoever's really running things, right? Biden's group, right? The 6 to 8 people that are really running things behind the scenes, they're as economically Trump as Trump. And so we think good things for the stock market, regardless of who. Now, if Biden gets hot swapped out by somebody else, we'll see. But the people that they've been talking about, whether it's Kamala or whatever, do not have the ability to override Congress's, I'll say, better thinking on issues. So even if they go super left, the way Newsom could, right, or Kamala might, I don't think they'll have the power to actually make things happen. And again, we'll have, even with the hot swap of Biden with somebody else, we still have either Trump or a group that is much more U.S. economics friendly, like it has been, frankly, for the last 8 years.
Yeah. Joel Litman from Altimity Research joining us, of course. That was great, man. I could have talked to you about a lot more topics, but we'll have to leave it there. Appreciate your time. Thank you.
Thanks, Jeremy.
I'm Jeremy Szafron. For all of us here at Kitco News, we want to thank you for joining us at the Rick Rule Symposium here in Boca Raton. We'll have coverage all week. Lots of great content coming up. Be sure to subscribe, hit that follow button, and we'll see you next time.
Kitco News special coverage of the Rule Symposium, Natural Resource Investing, is brought to you by G Mining Ventures.